everyone. I'm your host Ibrahim Sani and welcome to another episode of RHB Money Chat. Joining us for this week is Michael Chang, the Chief Investment Officer Fixed Income, and Mohammad Fauzi, the Chief Investment Officer Equity at RHB Asset Management, who will both be sharing some insights into the Malaysia Market Outlook for 2022. Thanks for joining us, Michael and Fauzi. Malaysia has been a laggard market compared to our peers in ASEAN. What would be some of your views when it comes to the performance for 2022? Maybe Fauzi, you can start first.
Right, thank you, Ibrahim. If you refer to the chart, it shows the big underperformance between Malaysia and other markets in ASEAN. Malaysia is the worst performance index in 2021. All markets in ASEAN registered positive returns, with the exceptions of Malaysia and Philippines. However, Philippines marginally down only in 2021. There are several factors which contributed to the weak performance. The first one is we have the highest COVID-19 cases per million people in ASEAN. If we can refer to the table, it shows that Malaysia has the highest cases per million people who are infected with COVID-19 cases. This has led to the government actually introducing the full lockdown from early June. Positively, the government has taken swift measures in its vaccination program. Malaysia is now among the highest country in the world, with 78.1% of its population fully vaccinated as of December 13, 2021. The accelerated vaccination program has led to the government to open up the economy gradually from July. The second reason why we are underperforming the rest of the region is the high COVID-19 cases have led to the government imposing the lockdown, which has impacted negatively Malaysia economy in the third quarter 2021. Although every country in ASEAN suffered a slowdown in the economy due to the resurgence of the COVID-19 cases, Malaysia economy was the worst in ASEAN in third quarter 2021. And the third point is the lockdown has impacted negatively the corporate earnings growth, which is important to the index performance. If you can refer to the chart, the corporate earnings growth was initially downgraded by 8.2% from April until end of October due to the rise in the COVID-19 cases and the lockdown, then followed by imposition of the Cukai Makmur, which has brought down the corporate earnings growth by further 3.6%. Compared with MCO1, corporate earnings growth was downgraded by 11.3%. The downgrade in the earnings are now close to 11.8% from end of April 2021. This was slightly higher, although fundamentally the economy is on strong footing now compared with last year. The imposition of Cukai Makmur has dented the prospect of a strong recovery in the corporate earnings growth for Malaysia in 2022. Now let us compare the corporate earnings growth with other ASEAN markets. If we can refer to the chart, if we compare with other ASEAN countries, only Malaysia and Philippines experienced corporate earnings downgrade from April 2021. However, Philippines has superior earnings growth compared with Malaysia. The rest of the ASEAN countries recorded an upgrade in corporate earnings. Interestingly, Indonesia saw sharp decline in the earnings growth but recovered from April 2021. Malaysia earnings growth, which already low relative to the other countries in ASEAN at the beginning of the year, was downgraded due to the prolonged lockdown and downgraded further due to the imposition of Cukai Makmur. Having said that, we are positive on the outlook going into 2022 as the economy is improving after the government gradually eased the lockdown since July. In our opinion, this would have a positive impact on the corporate earnings growth going forward. Most important thing to monitor now is whether earnings growth downgrade has bottomed out.
Thanks, Fauzi. While we are expecting recovery for the Malaysia market, maybe Michael, you can take on this question. What would be some of your expectation of rate hikes in Malaysia?
Thanks, Ibrahim. Good afternoon, everyone. So BNM is not in a hurry to raise interest rates for Malaysia. I think there are still negative output gaps and also growth uncertainties that's still lingering between the Malaysian economy. Accommodative monetary policy will complement the current expansionary fiscal policy in the first half of 2022. So given this predicament, I think if the economy is only solidly entrenched and core inflation starts to look elevated, will then only Bank Negara be responding to its first overnight policy rate hike of 25 basis points, likely only in third quarter of 2022. So this is also where we are actually, Malaysia is embarking into normalizing interest rates from its record low levels of interest rate for the OPR, the lowest in history right now. While likely we will see trend growth of between 5.5% to 6.5% for the MOS, which has been forecasted for this year in 2022, on the back of potential recovery and also because of rehiring, we will actually see the economy not going back to pre-crisis growth in the medium term, because as we see, we're still seeing some challenges, whether is it globally or for Malaysia. So the recovery here, what we're talking about, it's more of a supportive of policies that can actually help in going into this recovery of growth for Malaysia. So in terms of what we're seeing in the bond market right now, the interest rate swap market is pricing in for a 2.5% OPR in 2022, and then from 2.5% to 2.75% to 3% 2023. What the market is expecting is a more hawkish view in that nature. That's why it's being shown in the slide. So yeah, that's what it is right now, Ibrahim.
Yeah, I just want to focus still on Michael. Will Malaysia face inflationary pressure for 2022? If it does, how should investors mitigate this risk?
Very good question, Ibrahim. So people are still generally wary of inflation because we are seeing actually last year episodes where we actually saw inflation picking up, especially in the second half of 2021. For this year, I think people, while we are still generally wary of inflation, we don't think that Malaysia's inflation would get out of hand. What we have seen so far, the data that suggests is mainly cost push driven and mainly led by transport prices because of supply disruptions, not demand led from what we are seeing from the data. And therefore, with this backdrop, it's unlikely that it would lead to more aggressive rate hikes. So with that, the policy from monetary policy side, it does not need to be overly aggressive in terms of addressing inflation, because we are likely to see local inflation being transient and should normalize once supply and logistic shortcomings ease in 2022. So to mitigate this risk of inflation, I think investors should stay invested to meet their financial goals, whether be it in equities or fixed income, to avoid inflation eroding wealth over time. If investors prefer predictable income streams, they can actually invest in bonds or sukuk. So in the chart, I think you will rightly see that most of the cost push inflation were mainly driven by transport sector. So right now, I think the local bond market does seem to be oversold in my next slide, and relatively cheap. And this is actually reflected in the yellow shaded area, where we actually see it's actually wide against the US Treasury. We have actually seen some yields trending lower for US Treasury, but we have actually seen yields remain elevated in the local bond market in terms of the local government securities yield.
Okay, so Fauzi, we've heard some comments from Michael regarding the bond market or debt market. Maybe you can focus on the Malaysia equity market. What will be some of the sectors that you prefer?
Thanks, Ryan. Okay, as the economy moves from the recovery phase to expansion phase, actually, it comes along with acceleration in core inflation. Thus, we expect a broadening monetary and fiscal policy normalizations. During the expansion phase, sectors such as industrials and commodities should benefit. Our strategy is focusing on the reflation theme and continue to be positive on the economic reopening theme. The continuous improvement of the COVID-19 situation should lead the government globally to gradually open the economy in 2022, although the path will most likely be uneven and bumpy, we think. We are positive on sectors, for example, banking, commodities, energy, and also the economic reopening sectors.
So 2022 is also going to be an interesting year. We're going to come out of the COVID right now. Do you expect sustainable inflow from foreign investors into Malaysia for 2022 and even maybe 2023?
Right, thank you. If we can refer to the chart, this is the chart of the foreign inflows into Malaysia in 2021. If we can refer to the chart, November was the fourth consecutive months of net foreign buying on Malaysian equities. We view this positive as the foreigners have been selling Malaysia equities consistently since May 2018. The foreigners sold, example, 25 billion worth of Malaysian equities in 2020. Although the foreigners are still net seller of Malaysia equities in 2021, the amount has reduced significantly to around 2.46 billion. The past 4 months saw foreigners were net buying 3.53 billion of Malaysian equities. However, the foreigners turned net seller when the Omicron emerged, and they have sold around 1.098 billion in the last week of November and the first 2 weeks of December. Typically, foreign investors will focus on how strong would be the earnings growth and how attractive the valuations is before they decide to invest. In addition, US dollar movement is also important. Typically, strong US dollar will not encourage foreign funds to have more exposure, not only in Malaysia, but also in Asia as well.
Let's focus back on Michael. What would be some of your views regarding Asian high yield bond? Are you concerned about the China bond market, especially on property-related bond?
Thanks, Ibrahim, for that question. So we are actually constructive of the Asian high yield market, especially the Chinese property sector. If you look at the chart, there is actually goes with this, this explanation. You can actually see that the sell-off seems overdone. In fact, the Chinese high yield spreads is one of the highest if you put all the Asian high yield and then also the US high yield into the comparison. So Chinese high yield offers the highest yield among Asian high yield and also the US high yield. And it's also highest in recent history. So while volatility would remain high in first quarter of 2022, the situation should improve in the second quarter of 2022 onwards. Heightened volatility represents opportunities for one with investor which has the risk appetite. And also to note that the importance of the property sector to China, it's very much ingrained into their DNA for the GDP, because we're talking about at least 29% of the GDP of the property sector forms what China's GDP is all about. Property is also a sector where it has both economic contribution and also social cohesiveness. Therefore, we expect further loosening in the coming months, although we do not expect the authority to totally unwind the previous policies, which is a little bit more restrained in terms of the property sector. So in terms of China bonds, I think we were talking about Chinese renminbi denominated China government bonds. We like it because of its high yield versus most of the G3 government bonds. And then for the Chinese market, we are probably seeing the reverse, where globally we're looking at higher rates. We'll probably see the reverse in terms of the interest rate path for China, because of this that we spoke earlier about the potential slowdown coming from the property, and also the fact that for the renminbi denominated Chinese government bonds, it also has a low correlation to most of the other asset classes, and the tilt of dovish buyers coming from People's Bank of China, PBOC. Yeah.
Let's focus back on equities. Fauzi, what would be some of your target for KLCI for 2022?
Thanks, Ibrahim. If we refer to the historical chart, the index, we think the index is cheap from price earnings ratio valuations. We are of the view that the index may not trade down to the lowest PE of 13.8 times as before, as things have improved for Malaysia. The uncertainties in domestic politics, the high number of COVID-19 cases, and the lockdown were all behind us already. The government has been easing the lockdown measures gradually from July, and the economy has shown an improvement, and COVID-19 cases have come down significantly. The index has been trading at an average PE of 14.5 times past 5 months, and we view that this may be the floor valuations for the FBM KLCI index, despite many negative news from October. Based on our expectation on earnings growth and also PE valuations, the index may have limited downside. Upside would depend on how strong the corporate earnings growth, but based on our earnings expectation, we could still expect higher single-digit returns for FBM KLCI index in 2022.
I just want to focus on some of the material risks that you expect for 22. Do you feel that some risks need to be discussed or at least thought of for this year?
Right, thank you. Although we are positive on the market in the longer term actually for Malaysia, but in the short term, it is difficult to find positive catalysts for the FBM KLCI index to perform strongly due to the concerns over the impact of Cukai Makmur on the corporate earnings. Besides Cukai Makmur, there are a few other risks that worth mentioning here. The first one is the ESG concerns on the labor issues. The second one is the emergence of Omicron variant. We are not sure how bad actually the Omicron variant into the economy. And also, I think the high US inflation, if it prolong, actually it will also impact negatively on the economy and also on the market going forward. And also the accelerated US Federal Reserve tapering. And the last but not least, I think the state of the China's property market. That are a few concerns actually that may affect the performance of the equity market in 2022. But I think last but not least, as mentioned, the strength of the US dollar may also influence the directions of the stock market as Asia equities will tend to underperform when USD is appreciating.
Lastly, Michael, with prospect for global rate hike in 22 or even 23, what is your view on global fixed income?
So, Ibrahim, for the global fixed income, I think the US has turned more sharply more hawkish in their December 2021 meeting. Fed may look into doubling the reduction pace of its asset purchase program to 30 billion in January, and to stop its asset program purchase program by probably March in 2022. US Fed also signal a steeper path of potential rate hikes, potentially looking at 3 times in 2022, and then another 2 more hikes in 3 times in 2022 and 2023, and then 2 more hikes in 2024 than what market expects. So it was actually a shift from 6 months ago when market was pricing in higher interest rates than what the Fed expects. So that's why I think in the following chart, you can actually see that originally, the Fed was guiding a little bit more dovish, actually, being plotted by the green line in terms of the FOMC dots median. But subsequently, you can actually see that, the red line, which was more of the market view of where interest rates are heading, the red line actually falls below the green line. What it actually means is that while now the Fed is more hawkish in terms of its view towards the OPR, market is somewhat thinking that, with all the happenings that's globally with resurgence of Omicron, etc., I think, this rate paths could be different for market, at least what they're pricing in the market right now. So pretty much why we're looking at higher rates from the US Fed's perspective is also their hands are so pretty tight because they're trying to seek and control inflation, leave them little choice but to hike rates. But I guess what we need to see right now is how aggressive are these hikes. US will still have to go through with its taper before any rate action or its first interest rate increase. So given the hawkishness of US Fed versus other major central banks, with the exception of PBOC for China that I have mentioned just now, we are actually cautious on rates, especially the US Treasuries, US government bonds per se, because I think there's still market is still have to be a bit more resilient to what is coming from the rate hikes. But I guess with potential risks of Omicron and the rest, potential lockdowns that we have seen in the last couple of weeks. And then towards New Year, we actually saw a major cancellation of flights in the US and all that. So I think growth will somewhat be a little bit moderated from here. So that will actually potentially yields may not go up as much as how Fed has guided. So on this note, I think we prefer credits over rates, because I think credits are, it's benefiting from reopening, especially for Malaysia. And this is also, to a certain extent, also gives some buffer against rate hikes coming from the US.
Thank you, Michael and Fauzi, for the enlightening insights on the Malaysian market outlook. I think we got both stories from debt and equity. Michael, of course, is the CIO fixed income, and Fauzi is the CIO of equity at RHB Asset Management. So these insights are truly, truly wonderful to be had. If you are interested to find out more about the 2022 Malaysia Market Outlook, do leave a message. Our consultants will try to reach out to you as soon as they can. And thanks for tuning in to the RHB Money Chat. My name is Ibrahim Sani. Catch you in the entire series. It's going on for the next few weeks. So if you've missed any part of this, just look out for the RHB Money Chats from the other series as well. Again, thank you very much for joining. Catch you in the next one.